What's good, everyone, and welcome back to the Financial 4 channel. We are on our free money list series number 2, talking about identifying price trends. So in this portion, we'll learn the basics on how crucial it is to comprehend both short-term and long-term price trends within the price chart, as well as how to spot when these trends have changed. There's just so much to know when it comes to trends, and we will cover more of it in series 2 of our options trading course, where I give out all the secrets. But for now, we just want to stick to the basics so that no one gets confused, all right? So grab your notebooks, buckle up, hands and feet inside the right at all times. Let's go glitch money. So short-term trends are those that develop inside the price chart and take their cue from the most recent price movement. So as shown in the image, a short-term uptrend is characterized by a series of bars with higher highs and higher lows than the prior bar. These higher highs and higher lows are often referred to as pivot points, aka the trend structure. So likewise, a series of bars with lower highs and lower lows than the previous bar is a short-term downtrend. So for these two types of trends, these are their criteria, all right? And you can use the following guidelines to determine whether you are witnessing a short-term uptrend or a short-term downtrend, without a doubt, all right? So first is a short-term uptrend can only be reversed by a bar with a lower high and a lower low. Only a bar with a higher low and a higher high can break a short-term downtrend. So with the help of these two rules, you can quickly determine, which way the short-term trend is moving, all right? So while it is still important to recognize price conditions that do indicate a change in trend, it's equally important to recognize price conditions that, despite appearing significant, do not actually signal a change in price trend. So determine what price activity is actually just noise and not a leading indicator of changes in price trend by using the next types of patterns we'll examine. So first is inside bars, all right? So inside bars are a particular kind of condition that doesn't satisfy the prerequisite of a shift in price trend. Inside bars indicate a pausing in momentum because the entire price movement of the current bar or the candle is contained within the range of the bar or candle before it. So as a result, inside bars typically do not technically meet the condition for a change in price, all right? But there are three, conditions that fit the description of an inside bar. So first, the previous condition, or should I say the previous candle, encompasses the entire range of the current one, all right? Secondly, the current candle's high price is equal to the top of the previous candle, and the current candle's low price is higher than the previous low's bottom, all right? And then thirdly, the candle's low and high are both equal to those of the previous candle's low and top respectively, all right? So just remember that sometimes this could be a simple pause in a downtrend or an uptrend. To play this pattern in a reversal of a downtrend per se, what would need to happen is the next candle after the small inside bar must break and hold above the high of the previous candle that came before the inside bar candle. This would certainly signal a reversal, all right? And then next there's the outside bar. So whilst inside bars don't indicate a change in price trend, neither do outside bars technically. Outside bars don't meet a change of trend condition because the entire price action of the current bar or candle is contained within the range of the previous bar or candle, indicating a pausing of momentum. So again, there's three types of conditions that meet the criteria of an inside bar. First, both the high and low of the range are greater than the previous period. Secondly, the high of the range is equal to the high of the previous period, and the low is lower than the bottom of the previous candle. And then thirdly, the low of the period is equal to the low of the previous period, and the high is higher than the top of the previous period or the previous candle. All right. And so the 6 criteria, along with the higher highs and higher lows, and the lower highs and lower lows, basically cover all potential bar conditions, making it simple to ascertain short-term downtrend. Okay. So the inside bar conditions that do not signal a change in price trend and that will help you identify insignificant price activity basically has now been covered. All right. So instead, we'll just kind of concentrate on actions that will help indicate the short-term trend instead. All right. So the final step in figuring out the short-term trend is to assign a P for peak and a T for trough to each trend change or momentum shift that occurs on the short-term price trend. So by reviewing past price activity, we can identify short-term price trends and label peaks and troughs in accordance with those trends. So reversals of short-term trends are denoted by a P for short-term uptrends and then a T for short-term downtrends. All right. So similar to what you see an example, this structure will show a series of peaks and troughs. All right. So basically, this image shows how a real chart would look with peaks and troughs labeled. And it's pretty easy to identify the trend's direction once the peaks and troughs have been labeled. All right. So now for long-term trends, it's important to assess short-term trends in price activity. It's also important to determine long-term trends as well. So like once the analysis is carried out on the short-term trend, the analysis can be taken a step further to identify the long-term trend inside of the price chart. All right. The same analytical process used earlier to determine the direction of the short-term price, the price trend, is basically now being applied to determine the direction of the long-term price trend. It's the same stuff, just a bigger time frame. All right. So what we are looking to identify is if the peak and trough are both higher than the peak and trough of the previous period, or conversely, if the peak and trough are both lower than the previous period's peak and trough. All right. While this, may seem kind of confusing, a simple way to remember is by understanding the following steps. All right. So remember these, write these down. If there is a sequence of a peak, a higher trough, and then a higher peak, this will define a long-term uptrend. If there is a sequence of a trough, a lower peak, and then a lower trough, this will define a long-term downtrend. This style of analysis makes it easier to identify the direction of, the long-term trend in tricky markets where the price action is not so obvious and it's choppy, right? So assessing both long-term and short-term trends will give a better indication of expected price trends as opposed to assessing them in isolation, right? So all of this type of, analysis may seem a little confusing still at first. Once you put it into practice and into repetition, the logic of how it works will, quickly make sense to you, right? And as you can see in the example, the price trends are a lot easier to see when they are broken down in this manner, and you can quickly determine the direction that trades should be placed in. All right. So in theory, trends can be easy to identify, especially when there are lines drawn and things are evenly spaced, as illustrated in the previous examples. The example applies the theory to a real chart to show how it will look in a trading environment. You can see an uptrend just by looking at this chart, but trends aren't always that obvious. Trust me, in a real market. So I'll demonstrate how the peaks and troughs method can be used to identify trends. Firstly, you have a trough at the start of the chart marked with a T. You can then see the price reversal near the top of the peak, which is marked with a P. And then as you go through the stages of the short-term analysis, the peaks and the troughs begin to form, painting a clearer picture of what the trend is doing. You can label higher peaks as HP if you want, or higher high, depending on how you want to, word that or phrase that, and higher troughs as HT, or a higher low, which would be HL. as this makes it easier just to visualize, right? So once all the peaks and troughs have been labeled, it's easy to draw connector lines that link the troughs and the peaks together. And as you can see in the image, even though you are looking at a real chart, identifying this trend is as easy as it was in the theoretical example earlier. Remember that the market is not always this clear in direction. So it's good, just to get out there and practice to label the peaks and troughs for the more challenging market conditions. In between all of the labeled peaks and troughs in the image, you can see that the only time the trend reversed was when there was a candle with a higher high and a higher low, or a lower high and a lower low. All right. Remember, those are pivot points, aka the structure of the trend, right? Now let's look at how you would apply the same setup in a long-term downtrend. Again, once all of the peaks and troughs are marked out, it becomes easier to see which of the peaks and troughs are higher or lower than each other. All right. So this image shows a real example of how the theory works in a long-term downtrend. You can now go through and label the peaks that are lower than the previous peak with a LP, or a lower low, LL, representing the lower peak, and you can mark troughs that are lower than the previous troughs with LT, representing the lower trough. Once this is completed, again, it's easier to draw, connector lines that link the troughs and peaks together. And as you can see, even though you're looking at a real chart, identifying the downtrend is as easy as it was in the theoretical example earlier. You need to keep in mind that although this downtrend looks obvious, the market isn't always as clear. So it's good to practice to apply this method to remove any uncertainty as to which way the trend is headed, right? Once the direction of a long-term trend has been identified, it is just as important to understand when that trend has changed direction. So the example on the left displays a series of higher peaks and higher troughs. When the price reaches a lower peak and then declines further to reach a lower trough, a change in trend has taken place, right? A change of trend occurs when basically price makes a lower peak and then continues down to make a lower trough. Once this sequence happens, the longer term uptrend has ended and the sequence that starts a long-term downtrend begins, right? So the example on the right displays a series of lower peaks and lower troughs, indicating a long-term downtrend. A change of trend occurs when price makes a higher trough and then continues up to make a higher peak, right, or a higher high. Once this sequence happens, the longer term price downtrend has ended, and the sequence that starts a long-term uptrend begins, right? So now finally here, let's look at a real example of how the long-term uptrend can change. So in the image, you can see that there are a series of higher peaks and higher troughs that are confirming a long-term uptrend. There is a scenario where price has formed a lower peak closer to the chart's end. This is the first indication that a trend change may be imminent, right? Closer to the end of the chart, there's a situation where price has formed a lower peak. This is the first signal that there may be a potential change of trend, right? Once price crosses below the previous higher trough, this is confirmation that the current long-term uptrend has come to an end, and the new sequence of a trough, a lower peak, and now a lower trough confirms that a new long-term downtrend has commenced. So in the example, it shows a series of lower peaks and lower lows that are confirming the market is in a long-term downtrend. And then close to the end of the chart, there's a situation where price has formed a higher trough. This is the first signal that there may be a potential change in trend. Once price crossed above the previous lower peak, there is confirmation that the current long-term downtrend has come to an end, and the new sequence of a peak, a higher trough, and now a higher peak confirms that a new long-term uptrend has commenced, right? So you have now been able to establish the short-term and long-term trends inside the price chart without using any special tools, any special indicators, except for the most important one, the leading indicator, the king of all indicators, price action. Price action we'll go into that later, but basically price action is the language of the charts, right? You need to understand price action. It's the most important. All right. But anyways, this method works in any time frame exactly the same way. But remember that the larger the time frame, the more significant the trend. All right, keep that in mind. All right. So this finishes off our portion of price trend analysis. Next, we will talk about multi-time frame analysis. Very, very important. This is Bradley Barnett. I love y'all from yours truly, Financial Fool.